Welcome to ETF Battles. I'm DeLegge, and we've been drenched with battle requests for technology-focused ETFs. And shame on us for appeasing the audience. I mean, we're supposed to be nonconformists. And at this point, I think the best that you can say is that we're confused nonconformists, because once again, we're going to appease the audience, because today's matchup is between the ARK Next Generation Internet ETF, that's ticker symbol ARKW, versus the Vanguard Information Technology ETF, ticker symbol VGT. Although both funds own the same types or similar types of stocks, that's in the tech sector, ARKW is actively managed, whereas VGT is indexed. Our judges are going to tell us more about that in a moment. Helping us to sort through this ruckus and judge this matchup is John Davi, founder and CIO at Astoria Portfolio Advisors. And we've got Todd Rosenbluth, head of ETF and mutual fund research at CFRA. Gentlemen, I'm honored by your presence.
Great to be with you, Ron and John.
Great to be with you guys.
So we've got our four battle categories, which are cost, exposure strategy, performance, and then we've got our mystery battle category where you, our judges, can pick that one factor or several factors that you feel are important to today's matchup. We're going to go through each one of these battle categories one at a time, and you've got 30 seconds in each category. And then at the end of all of these categories, we're going to, of course, declare a final overall battle winner. Keep in mind that today's matchup could also end in a split decision. That's always a possibility, but we're just going to have to wait and see. So we're going to begin with our first battle category. We're going to start with cost, and we'll begin with John. You've got 30 seconds. Go.
You know, ARKW has 76 basis points management fee. VGT is 10 basis points, but you really can't compare them. One is actively managed. The other is a passive, index product. I think ARKW is pretty reasonably priced for providing high active share, a lot of exposure, in the tech space. The number sounds higher, but if you think about the return per unit of expense ratio, I think it's pretty reasonable, especially when you compare that to mutual funds, actively managed mutual funds, which are like 1.5%. So I don't know if I have a winner per se, but I just know that like ARKW is reasonably priced relative to, what it's delivering to you.
So you're a split decision or ARKW, you're on the fence.
I think, I don't know. I don't know how to answer this question. I truly don't know how to answer this question. I'd be curious to know what Todd thinks, but I'm just amazed that you can get, pretty good returns, historically speaking, no guarantee it's going to happen in the future, at a reasonable expense ratio. And you're getting a manager that actually puts pretty high conviction, which if you look in the mutual fund world, you charge 1.5% and you get pretty low active share.
Just call it a split decision. He can't. He's sitting here trying to figure out which of his two kids he loves the most.
Well, he's convincing me. The more I listen to him, he's convincing me that actually ARKW should be the choice here in terms of the better. Cost per expense ratio per unit of performance. That sold me right there.
Yeah, I don't know if the question is correct. Is my point. Like, I'm just having a conversation about costs, but I don't know if that's really the right question to be asking, because it's two totally different things, if you ask me.
Okay, so let's shift to Todd. Todd, what is your take in terms of cost? Who wins the battle?
This is simple math here. One costs 76 basis points, one costs 10 basis points. I went to Michigan, as you can see in the background. We learned that 10 is less than 76. It's a much cheaper product. It's also much more liquid. It has more money. It trades more volume. VGT is the cheaper product. We'll get to performance in upcoming categories, John, but on a cost standpoint, VGT is just cheaper. Just let's say it that.
Did you have to go to Michigan to figure that out, or maybe?
I think it's just New York, in the New York public school system that I think you and I both made it through. We learned 10 is less than 76.
Wow, this is getting entertaining. I'm so glad I skipped lunch. So let's move on to the exposure strategy. Let's stick with you, Todd. Who wins the battle between these two ETFs?
So I know you told the audience that you were responding to technology-oriented ETFs, but I wouldn't consider ARKW to be a technology ETF. So I'm comparing these as two growth-oriented ETFs.
Okay.
And from an exposure standpoint, ARKW has better exposure. Technology, there's communication services companies, there's consumer discretionary companies as well. Tesla, strangely, in something that's Web 2.0, but Tesla is the largest holding within ARKW. That's clearly not a technology company. So from an exposure standpoint, if what you want is the broad realm of thematic technology and other areas to it, ARKW is the winner.
Very good. And thank you for making that clarification too on technology. Really, it's certainly not the sector that it was 5, 10, 15, 20 years ago, and it's ever evolving. But again, solid points that you make. Let's shift to you, John. How do you see it in terms of exposure strategy? Who wins the battle between these two funds?
Yeah, I think Todd nailed it. We call something like ARKW as a secular growth strategy. So names that have very strong earnings, very strong margins. I think that you're getting really a secular growth wrapper strategy in a tax efficient wrapper. So the names like Tesla, Roku, Square, Zillow, Facebook, these are all the amongst this, the best performing stocks year to date. So I like the secular growth cohort. So we actually do some portfolios on our side where we, pick secular growth stocks for our clients. So this ARKW kind of reminds me of some of the stuff that we do internally at Astoria Advisors. So I'd give the battle category winner to ARKW.
Okay, for exposure strategy. And thank you for using that word cohort. I haven't heard that one in a while. Cohort.
Yes.
You say cohort, I say cohort. Okay, let's move to performance. Let's stick with you, John. Who wins the battle between these two ETFs?
Year to date, 1 year, 3 year, 5 year, ARKW does outperform the VGT ETF. I mean, you really can't compare them. Like one is just pure tech, the other is these secular growth stocks, which the way we create our secular growth strategy, they've also performed very, very well historically speaking. So the battle category winner in my eyes is ARKW.
All right, Todd, how do you see it? Do you agree with John's analysis on performance?
I do. I mean, ARKW has doubled within the past year. It's up, considerably on a 3-year basis as well. While you're taking on a little bit more risk through ARKW, and I know we both think risk-adjusted performance is important too. VGT, it's doing very well. No one should be unhappy with 27% return through the middle of September, which is what VGT has, but a doubling, very impressive. It's a much stronger performer ARKW.
All right, let's move to the mystery battle category. This is where our judges can pick whatever factor or several factors that they feel are crucial to today's analysis and match up between these two ETFs. Todd, how do you see it? Tell us about your mystery battle category, what it is, and who's the winner.
So the mystery battle category, CFRA has an independent rating on over 1,800 different ETFs, forward-looking rating that incorporates holdings, it incorporates costs, which we touched on, it incorporates performance that we touched on, and ARKW is a 4-star rated ETF, whereas VGT is a 3-star rated ETF. And again, simple math here, 4 is better than 3. We like ARKW from an overall ratings perspective, and it encapsulates all the great characteristics we touched on earlier, that forward-looking CFRA rating.
Okay, so ARK is the winner for your mystery battle category. What about you, John? What is your mystery battle category and who is the winner?
We're going to use earnings growth for us at Astoria Portfolio Advisors as the mystery category. And when I look at ARKW and VGT, on a 2021 earnings per share basis, you've got, significantly higher earnings growth with ARKW compared to VGT. And it's no surprise. It's a lot of the companies I mentioned before that, are producing, pretty strong, robust earnings. So, which makes sense because it's a secular growth strategy. So, whether I look at 2021 or 2020, earnings share is pretty strong in the ARKW compared to the VGT.
All right, so that's your winner. And this is your final opportunity, judges, now to weigh in with your overall battle winner, and we'll stick with you, John. Who is your overall battle winner between ARK and VGT?
You know, at Astoria Advisors, we are active managers. You know, we just happen to use a lot of ETFs with our active, portfolios. We do create, custom stock portfolios too, of which secular growth is one of them. So ARKW reminds me of our secular growth model portfolio of 30 names. You know, I've listened to Kathy Wood. You know, she's very impressive. I think she does a good job. Per unit of return, per cost, I think we get a pretty attractive risk return stream delivered in a very efficient tax wrapper with an ETF. Frankly, every other actively managed mutual fund, I think, should have the same view and lens of how she approaches the ETF business. So I would say overall, my category winner across all of them is ARKW.
All right. Thank you very much for weighing in. And this is your last opportunity, Todd, to give us your overall battle winner between these two ETFs.
Yeah, so my winner is ARKW. Costs matter. It certainly matters within the ETF space, and that's why it's one of these four categories that we have. But from an exposure, from a performance, from a holdings that incorporate risk and reward attributes, which is what CFRA focuses on, we think ARKW is a stronger product. I'd add that it's probably very few people who would have thought you'd have an old school index-based product versus an actively managed ETF that people tend to think are oxymorons, and see that the oxymoron-based product, ARKW, comes out as the winner. I think John and I are in agreement on that.
Well, very good. You both judges raised some excellent points, and according to my scorecard, today's battle winner is ARKW over VGT, beating it in exposure strategy and performance, mystery battle category, overall battle winner. Both of our judges agreed in that department also. And I think a couple of the key takeaways, well, let me just focus on one key takeaway for today's program. And I think it's that indexing wins most of the time, but not all the time. And I think this is a case study example of exactly that. With an actively managed ETF, ARKW, which has outperformed its index counterpart and many other passively managed index counterparts in its same category by a pretty wide margin. So again, a big thanks to our judges, Todd and John, for weighing in and for their camaraderie and always excellent analysis. We hope to catch up with you judges soon.
Thanks a lot, Ron.
Thanks, Ron.
Well, that does it for another round of ETF Battles. Which battle would you like to see? Give us your ticker symbols. Hit us up on our YouTube comments section. Be sure to hashtag ETF Battles. You can also find us on Twitter at ETFguide. I'm Ron DeLegge with ETFguide TV. And until we meet next time, watch the battle before you invest.